You are welcome to one of the interesting courses we offer during your study in Lautech Open and Distance Learning Center, ACT 212, Accounting Information System. I'll be taking you through study session 3 with the title Accounting Records. Accounting records are all sources of information and evidence that are used in preparing, verifying, and or auditing financial statements. Accounting records also include documentation to prove ownership of assets, creation of liability, and evidence of monetary and non-monetary transactions. In this study session, you shall be introduced to the fundamental of accounting records and accounting terms like debit, credit, double entry, and explain the accounting cycle steps. At the end of this lecture, you should be able to describe the term debit and credit, define double entry, explain the accounting cycle. In an accounting statement, the left side of any account is the debit side, while the right side is the credit side. All assets and expenses increase in the debit side and decrease in the credit side. All liabilities and revenue increases in the credit side and decreases in the debit side. Stockholder equity, common stock, and retained earning increase in the credit side. Dividends increase in the debit side. Now let's look at double entry. The double entry system of accounting or bookkeeping means that every business transaction will involve two accounts or more. For example, when a company borrows money from its bank, the company cash account will increase and its liability account, loan payable, will increase. One of the topics we'll be discussing is the accounting cycle steps. Now let's look at the elements of the accounting cycle steps. We have identifying and measure transaction and events. We have journalism, we have posting, we have unadjusted trial balance, we have adjustment, we have adjustment trial balance, we have statement preparation, and closing. This sums up to the elements of accounting cycle steps. Now let's take a quick talk on the explanation of the accounting cycle steps. Identifying and measure transaction and events. Transaction and events used to describe the changes in an entity asset, liability, and owner's equity. Transaction are particular kind of external events, maybe an exchange in which entity both receive and sacrifice value. Events are of two types. We have the external event, which involves the interaction between an entity and its environment, and we also have the internal event, which occurs within an entity. Another element of the accounting cycle step is journal, and under journal we have the general ledger. It is the collection of all assets, liability, stockholders' equity, revenue, and expenses account. Journal is the book of original entry where transactions and selected other events are initially recorded. General journal. When we talk about general journal, it consists of 4 parts. the account and the account to be debited, the accounts and the accounts to be credited, the date, and an explanation. We also have special journal. This special journals expedites the journalizing and posting process for frequently occurring transactions. The most common special journals are sales journals, purchase journals, cash receipt journals, and cash payment journals. Posting is another element of the accounting cycle step. It is the process of transferring the essential facts and figures from the book of original entry to the ledger account. The number in the posting reference column serves two purposes. 1. Indicates the ledger account number of accounts involved, and 2. To indicate that the posting has been completed for the particular item. Trial balance. It is a list of accounts and their balances at a given time. The primary purpose of trial balance is to prove the mathematical equality of debit and credit. A trial balance also uncovers error in journalizing and posting. In addition, it is useful in the preparation of financial statements. We have adjusting entries. They are made at the end of the accounting period. In short, adjustments are needed to ensure that the revenue recognition and matching principles are followed. Adjusting entries are required every time financial statements are prepared. Types of adjusting entries. Adjusting entries can be classified as either prepayment or accrual. We also have closing as accounting cycle step. It is the procedure generally followed to reduce the balance of nominal account to zero in order to prepare the accounts for the next period transaction. Lastly, we have the reversing entry. It is made at the beginning of the next accounting period and is the exact opposite of the relating adjusting entry made in the previous period. Thanks for listening. I hope you enjoyed the lecture.